If your projects involve residential, commercial, or mixed-use properties, there are 6 major legislative changes that you need to know about. Permanent QBI deduction for pass-throughs. If you're operating as an LLC, partnership, or S Corp, the 20% deduction for qualified business income is now permanent, and there's a new floor. Even a small amount of QBI can translate into a guaranteed deduction of $400. This helps stabilize your tax expectations, especially when dealing with partnership distributions or RIT dividends. 100% bonus depreciation returns. Starting in 2025, qualifying property placed in service can be fully deducted in the first year. That includes things like HVAC systems, lighting, appliances, and newly certain manufacturing or industrial buildings. Opportunity zones become permanent. The tax benefit for investing in designated low-income zones is now a permanent part of the tax code. States can designate new zones every decade, adapting to population shifts and regional trends. The key advantages remain: defer capital gains tax for 5 years, receive a 10% basis step-up, and if the investment is held 10 years, appreciate tax-free, subject to rules. Rural areas get more flexibility with lower thresholds and higher step-ups. Boost in affordable housing incentives. The low-income housing tax credit gets a lift with states receiving 12% more in allocations. The requirement to use tax-exempt bonds is halved from 50% to 25% of project costs, which reduces financing obstacles. This helps narrow funding gaps when pursuing housing projects intended for lower-income residents. Greater flexibility in interest deductions. The cap on business interest deduction is now tied to EBITDA instead of EBIT. This means depreciation and amortization are added back, giving more breathing room to deduct interest for leveraged projects. You can still elect out of these limits, but doing so affects how you must handle depreciation. Energy incentives are time-bound. Some favorable tax credits for energy efficiency don't last forever under the new law. Section 45L for energy-efficient residential units is available only through June 30 of 2026. Section 179D for commercial energy upgrades also phases out for buildings that begun construction after June 30, 2026. Here's how to move forward. Review your pipeline of capital projects and decide which ones to accelerate or to postpone. Examine whether opportunity zones or enhanced LIHTC allocations fit in your portfolio. Reassess your financing structure, especially if you carry debt. The change in interest deduction rules can influence leverage decisions. If you have energy-efficient upgrades in mind, check whether they must be scheduled before the mid-2026 cutoff. Partner with your tax and financial advisors now. Aligning your project with these new rules can make a real difference in outcomes.